Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite, we have Michael Sokoll. He is the senior managing director on Nasdaq's Markets Intelligence Desk, and we are here with a weekly market review from the mid. Michael, as always, thank you so much for joining me. And volatility is back in the markets for sure. It's October. It's every trader's dream, and today it seems as if big tech is weighing on equities.
Yeah, it's interesting. You had some of the headline names in tech, Alphabet and Amazon reporting, and that got a lot of the headlines. If you look at the week, though, and even the year, people are running to safety for the last week. They're going into REITs and utilities performing less poorly than the rest of the market and consumer staples. But tech is actually just above that in performance. So everything else, energy stocks, material stocks, consumer discretionary stocks are actually faring much worse than tech.
Right. Well, you know what? The major averages, they've moved in and out of positive territory this week as we speak now. They're obviously down in negative territory. But since the highs in October, what has changed between now and then?
I think the focus is on rates much more so, and that's got to be it, because earnings are actually coming in about as expected, if not better in some cases in terms of the beat rates, in terms of some of the other metrics that you look at, even at earnings growth. It's about 22%, which a year ago would have been considered great. I mean, 25% in the last 2 quarters, 22 is not that bad.
Right.
So I think it's a combination of guidance going forward and certainly rates. People are worried about the pace of Fed rate increases.
Right, but the rate story has not changed from October 3rd to today. And if you think about it, rates, in fact, okay, yes, you have inflation, yes, bond rates get more expensive, but it also means that people are making more money. Wages are, in fact, increasing. We'll get more data on that next week.
Yeah.
But it doesn't feel like the narrative has changed.
So, yeah, and the question is are they raising rates for the right reason? Is it for economic growth, or is it because people are starting to focus a little bit more on the deficit in the U.S., $1 trillion going forward for as far as the eye can see? And the U.S. isn't in a vacuum. You have a lot of other countries performing poorly, and Europe and Asia have been down pretty much all week, emerging markets, and as the dollar strengthens, you start to wonder if those economies can't do well, can the U.S. be the only port in the storm that's doing well?
And you had mentioned energy before. Crude oil has had quite the ride this week as well, and I'm sure that's another underlying reason for the market movement we're seeing.
Yeah, I mean, I watch crude as an indirect indicator, for the market. And certainly crude has, if you looked at the end of the month last month, it was at 75 heading north, and then all of this last month it's been doing actually worse. Beginning was, there was a lot of headlines about Saudi Arabia, put a bid in oil for a little while, but now it's about growth again. So oil prices come down when people fear growth, and we're south of $70 again.
All right, let's take a look at the trading week ahead. Of course, we have the all-important October employment report coming out on Friday, and again, a heavy calendar with earnings. There's some big names out there next week.
Yeah, a ton of big names. I think we have probably 300 companies or more of just names you'd recognize, and a handful of the big names, Amgen among them, Pfizer, some bellwether names, and certainly earnings season is going full swing. And we're going to have to hope that we get some good reports from companies that is well received by the market. Hand in hand with that, the guidance is really what's driving it. So we'll have to look out for that. And, of course, the jobs report.
Right. What are your expectations? Do you think we'll continue on the trend that we've been on?
The trend has been great. I mean, lowest unemployment in long, long time. And the number of job openings is at a record, even though maybe there's a skills mismatch. So I think the market's interpreting that a little bit as more fodder for the Fed to raise interest rates, because if wages are going to push inflation up, they're going to try to stay ahead of that. And the market's interpreting that as actually, in some ways, a negative.
Right. All right. Well, thank you very much for joining us at MarketSite. And thank you for joining me throughout the week. I'm Jill Malandrino, global markets reporter at Nasdaq.